You know, what if the secret to actually beating the market wasn't about trading more, but about being way more disciplined? Today, we're cracking open Chapter 15 of Benjamin Graham's classic, The Intelligent Investor, to really get to the heart of his strategy for what he calls the enterprising investor.
Right off the bat, this chapter lays out a path for people who are actually willing to put in the work for better than average returns. But, and this is a big but, it is not for everyone. So before we go any further, you've got to ask yourself, does this sound like me? Am I really prepared to do what it takes?
So what in the world does it mean to be enterprising anyway? It's probably not what you think. Let's get a really clear definition because, honestly, this is the foundation for everything else we're going to talk about.
Yeah, this has nothing to do with chasing hot tips or trying to day trade your way to riches. It's all about diligent, careful work. An enterprising investor is someone who's willing to do the deep research to find not just good companies, but good companies that are trading at a great price. It's about actively looking for that value that pretty much everyone else has overlooked in the daily noise.
Okay, so let's say you're on board. You're ready to roll up your sleeves and do the work. But in a massive market with millions of people, where do you even begin to look for these hidden gems? Well, the chance for those superior returns actually comes from a few key places where the market just isn't perfect.
And here's the real kicker. The market isn't always this super rational machine, not even close. Opportunities pop up because of temporary problems or because a great company has just fallen out of favor for a little while. And of course, because raw human emotions like fear and greed often push stock prices way off from what a company is actually worth. The job of the enterprising investor is to find the logic right in the middle of all that chaos.
Okay, so we know where to look for an opportunity, but now we have to talk about the single most important idea for protecting yourself. Protecting yourself from your own mistakes and from all the craziness you just can't predict. This concept is the absolute core of this book.
This is not just some catchy little phrase. It is the bedrock of this entire philosophy. Graham himself just drills this point home again and again. You can think of it like the ultimate shock absorber for your investments. It's the bright, clear line that separates smart investing from just pure gambling.
Now, to really get what he means by margin of safety, you have to understand this one simple but incredibly powerful difference. There's the price, that's what you pay for a stock, what it says on the screen. And then there's its value, what the business underneath with all its assets and profits is actually worth. And here's the secret, those two numbers are almost never the same.
So here's how it plays out in the real world. Let's say you do your homework, and you are convinced that a business is truly worth $100 a share. You don't go out and buy it for 99 bucks. No way. You wait, patiently, for a chance to buy it at a big discount. Let's say $60. That $40 gap, that's your margin of safety. It's your buffer. It protects you from bad luck, from your timing being off, or even from the fact that your own analysis might not be perfect.
But here's where things get a little tricky. There's a paradox. Having all this knowledge to find value and the confidence to demand a margin of safety can lead you right into a dangerous trap. The biggest threat to your success might not be the market, but the person looking back at you in the mirror.
I mean, it seems logical, right? If you're this enterprising investor, you've got more skill, you have more insight, so it feels like you should be more active, right? Buying and selling, making moves, and capitalizing on every little thing you see.
And Graham's answer to that idea is a very clear, very loud wrong. In fact, he argues that the complete opposite is true.
Look, being enterprising is not a license to be hyperactive. The moment you start trading too much, you become your own worst enemy. Overconfidence starts to creep in, all those little transaction costs start to eat away at your money, and before you know it, you're just speculating on market noise instead of investing in real business value. And that is how an enterprising investor can lose their entire edge, just like that.
So that was a lot. How do we pull all this together? Let's try to boil it all down into a simple, actionable game plan that really summarizes the whole process.
It really just comes down to these 3 steps. First, you become a value hunter, actively looking for opportunities where other people aren't. Second, you build your financial defense by demanding that all-important margin of safety. And third, and this might be the hardest part, you master your own psychology. You practice restraint and have the discipline to not get in your own way.
And that really brings us to the final and most critical question. The opportunity to find value in the market will always be out there for people who know where and how to look. But the ultimate challenge, the thing that separates the winners from the losers, isn't about raw intelligence. It's about character. It's about having the discipline to stick to your guns when everyone else is freaking out. So the real question is, do you have it?